Are you planning for Medicare and concerned about how much your premiums might cost in retirement? You may have heard of IRMAA, but what exactly is it? And more importantly, how can you reduce it? In today's video, we're going to explain what IRMAA is, how it affects your Medicare costs, and strategies that might help you lower your exposure over time. Just a quick note. This video is for informational purposes only and should not be considered tax, legal, or financial advice. Always consult with a licensed professional before making any decisions regarding your finances or Medicare planning. IRMAA stands for Income-Related Monthly Adjustment Amount. It's an extra charge added to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. In other words, the more income you report on your tax return, the more you may pay for Medicare, above the standard premium. IRMAA is based on your Modified Adjusted Gross Income, MAGI, from 2 years prior. So for example, your 2025 IRMAA will be based on your 2023 tax return. There are 5 IRMAA income brackets, and once you cross into a higher one, your premiums increase. Even just $1 over the threshold can bump you into a new bracket. So how can retirees potentially lower their IRMAA? One of the most effective strategies is managing your taxable income in retirement. That might include reducing large withdrawals from pre-tax retirement accounts, like traditional IRAs or 401ks, or spreading out withdrawals over several years to stay within a lower bracket. Converting some of those funds into a Roth IRA, strategically and in smaller amounts, could reduce future required minimum distributions, RMDs, which in turn lowers your MAGI. But keep in mind, Roth conversions are taxable in the year you do them, so this strategy should be carefully planned. Another way to control your IRMAA exposure is through timing. If you have years in early retirement where your income is lower, before Social Security and RMDs kick in, you may consider accelerating certain taxable events into those low-income years. For example, realizing capital gains or converting IRA funds when you're in a lower bracket. Also, be aware of one-time income spikes like property sales, severance packages, or inheritances. These can unexpectedly push your MAGI above the threshold, triggering IRMAA charges 2 years later. Careful tax planning can help mitigate those surprises. In some cases, you may be eligible to appeal an IRMAA surcharge. If you've experienced a life-changing event, such as retirement, death of a spouse, divorce, or loss of income, you can file Form SSA-44 to request a reduction in your IRMAA tier. The Social Security Administration reviews these on a case-by-case basis, so proper documentation is key. If approved, your Medicare premiums could be lowered based on your current income rather than the 2-year-old tax return. You can also reduce IRMAA exposure by choosing how and when to receive income. For example, using cash savings, tapping Roth accounts, or selling investments with minimal capital gains can help keep your MAGI down in a given year. Qualified charitable distributions, QCDs, from your IRA, available after age 71-2, are another tool. QCDs satisfy your RMD requirement, but are excluded from your taxable income, potentially lowering both your tax bill and your IRMAA risk. To summarize, IRMAA can significantly increase your Medicare costs, but with thoughtful planning, you may be able to reduce or manage its impact. Key steps include monitoring your MAGI, planning Roth conversions carefully, spreading taxable events over time, and using tax-efficient income sources. While there's no one-size-fits-all solution, knowing how IRMAA works empowers you to take more control of your retirement finances. At Casa Arteaga Insurance, we're here to help guide you through these complex decisions, without pressure and always with your goals in mind. Give us a call today or schedule a no-obligation conversation by clicking the link in the description. And remember, this video is for educational purposes only. It is not financial, legal, or tax advice. Be sure to speak with a qualified professional before making any decisions. Thanks for watching. Please like, subscribe, and hit the bell to stay updated with more retirement planning insights.